Everyone wants to find the next Apple or Amazon before it takes off. The idea of striking it rich with a tech stock is hard to resist. But here's the truth, the chances of that happening are slim. In fact, 90% of tech startups fail, and most investors who chase big tech stocks end up losing money. Here's something else to think about. During the dot-com bubble, investors lost over $5 trillion when the market crashed. Most people don't realize that tech stocks can be risky, and the prices often don't match the company's actual worth. Value investors know this. That's why they focus on the fundamentals, not the hype. In this video, we'll uncover why you're unlikely to own the next big tech stock and show you smarter strategies. We'll dive into the risks, hidden traps, and how value investors spot the real winners that others overlook. Ready to see why slow and steady really wins the race? Let's get started. Chapter 1. The hype versus value. Why tech giants elude us. The world of investing is full of noise. Every day, a new tech company grabs headlines, promising to revolutionize the industry. Investors pour money into these companies, driven by fear of missing out. But as a value investor, you've probably noticed something. The next big tech stock always seems just out of reach. There's a reason for that. Value investing is about looking beyond the hype. Warren Buffett once said, "Price is what you pay, value is what you get." This mindset is critical. When tech stocks start to soar, their prices can skyrocket far beyond their actual worth. At the height of their popularity, companies like Tesla or Meta were trading at price-to-earnings (P/E) ratios that were 5-10 times higher than the market average. Sure, they're exciting, but their valuations often lack a solid foundation. In 2021, for example, the S&P 500 tech sector had a P/E ratio of 37.9, while the S&P 500 average was 22.8. For a value investor, that kind of inflated price is a big red flag. You can't just chase growth, sustainable value matters more. The problem is, by the time the general public hears about the next big thing, the stock is already priced for perfection. Buying at these elevated levels isn't just risky, it's almost a guarantee of disappointment. Why? Because you're paying for the hype, not the value. Value investors tend to shy away from tech stocks not because they don't like innovation, but because the fundamentals often don't match the excitement. Instead of buying into the frenzy, value investors focus on companies that are undervalued, with strong balance sheets and consistent earnings. It's not as flashy, but it works in the long run. Chapter 2. The hidden traps of overvaluation. Overvaluation is the elephant in the room when it comes to tech stocks. Many investors get swept up by promises of exponential growth without stopping to ask, is this company actually worth its price? History shows us how dangerous this can be. Let's take a trip back to the dot-com bubble. In the late 1990s, tech companies were trading at astronomical valuations. Many had no earnings, and some had barely any revenue. But investors didn't care. All they saw was potential. The bubble burst in 2000, wiping out $5 trillion in market value. Thousands of investors lost everything. The problem with overvalued stocks is simple. They're priced based on future expectations, not current realities. As Benjamin Graham, the father of value investing, said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. That means, eventually, the market corrects itself. Prices fall back to reflect the company's real value, and those who bought at the top lose out. Take Apple in 2000, before the iPhone. It was trading at a P/E ratio of 50. Today, its P/E is around 30, even with the massive success of its products. What happened? Expectations met reality, and the stock price adjusted accordingly. Value investors avoid this trap by focusing on companies with reasonable valuations. How do they do that? By sticking to fundamental metrics like the price-to-earnings ratio, price-to-book ratio, and free cash flow. These numbers don't lie, and they help investors see past the hype to what a company is truly worth. Chapter 3. The illusion of innovation. The risks you don't see. Innovation sounds exciting, but it can be a double-edged sword. Many tech companies thrive on the idea that they're going to change the world, but the reality is that not all innovations succeed. For every Amazon, there are dozens of companies like Pets.com that didn't make it. Investors often overestimate the value of innovation and underestimate the risks. According to a study by the Boston Consulting Group, over 70% of innovation-based strategies fail. That's a sobering statistic for anyone hoping to get rich off the latest tech breakthrough. Value investors aren't opposed to innovation, but they know that betting on it is risky. Instead, they look for companies with proven business models and strong financials. Why? Because businesses that are already profitable are much less likely to collapse under the weight of their ambitions. It's easy to get caught up in the excitement of companies like Tesla, which promise to revolutionize the automotive industry. But if you look at Tesla's financials during its rise, the company was losing money for years. For a value investor, that's a huge red flag. You can't rely on hopes and dreams to make a sound investment. As value investors, we understand that growth needs to be sustainable. Amazon, for example, lost money for many years, but it had a long-term strategy and clear path to profitability. Many tech startups don't have that. They're betting on innovation alone, without solid foundations. It's like building a house on sand. No matter how nice the house looks, it's going to collapse without a firm foundation. That's why value investors focus on companies with strong fundamentals, because they know the risks that others overlook. If you're finding value in this content, consider subscribing for more insights and strategies to enhance your investing journey. Chapter 4. Why fundamentals matter more than FOMO. The stock market can feel like a game of musical chairs. As prices climb, it's easy to feel the fear of missing out, FOMO. You see tech stocks shooting up and wonder if you're missing the next big win. But FOMO is dangerous for value investors. It can cloud your judgment and push you into making irrational decisions. One of the keys to value investing is patience. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." What does this mean? It means those who chase trends usually end up paying the price, literally. Tech stocks often thrive on FOMO, but their fundamentals don't always back up the hype. In 2020, for example, Zoom's stock surged over 400% during the pandemic. But by mid-2021, its price dropped by nearly 40%. The reason? Expectations were high, but the fundamentals didn't justify the inflated price. Value investors avoid this by sticking to solid metrics. How? They focus on the company's balance sheet, earnings growth, and cash flow. This data gives a clearer picture of a company's true value. While Zoom's stock fluctuated wildly, companies like Johnson & Johnson or Procter & Gamble, with steady earnings and strong fundamentals, provided stable returns. The strategy is simple: ignore the noise. FOMO might make you feel like you're missing out on easy money, but value investing is a long game. A study by Vanguard found that over a 30-year period, value stocks outperformed growth stocks by 1.4% annually. That's not a huge number, but over time, it makes a big difference. The lesson is clear. Don't let short-term hype drive your decisions. Stick to the basics. Fundamentals are your best guide. Chapter 5. How value investors spot the real hidden gems. While tech stocks grab headlines, value investors often find success in overlooked industries. These hidden gems aren't always flashy, but they have something that's even more valuable: long-term potential. The ability to spot these undervalued companies is what sets value investors apart from the crowd. Take Berkshire Hathaway's investment in American Express. In 1964, the stock had taken a huge hit due to the salad oil scandal, but Warren Buffett saw potential. While others were selling off their shares, he invested $13 million. Today, that stake is worth over $25 billion. What did Buffett see? Strong fundamentals and a company with a clear path to recovery. Value investors thrive on finding these hidden opportunities. Instead of following the herd, they look for companies that are flying under the radar. They focus on industries that may not be trendy but offer consistent, reliable returns. For example, companies in sectors like utilities, consumer goods, or healthcare often provide stable earnings, even when the market is volatile. The key to spotting a hidden gem is understanding intrinsic value. This means calculating a company's true worth by analyzing its assets, earnings, and future growth potential. One of the best tools for this is the discounted cash flow (DCF) model. It's not as exciting as chasing a tech IPO, but it works. According to a study by Morningstar, undervalued stocks have historically outperformed the broader market by 2.3% per year. That's because value investors buy when others are selling, and they sell when others are buying. They don't chase trends, they look for sustainable growth. In today's market, companies like McCormick & Company, The Spice Company, or Colgate-Palmolive might not sound thrilling, but they have delivered steady returns for decades. Why? Because they're well-run companies with consistent earnings and low volatility. If you found these insights helpful, don't forget to subscribe for more valuable tips and strategies to navigate the stock market wisely.